Hi folks, welcome to this video on calculating cash flow. Here before us we have part of the cash flow statement. We've always said we start with operating, then investing, and then financing activities to calculate our cash flow. So let's see how we would begin this problem given our data. It would be best if you printed the data in the question so that you can follow along with the video solution. Now you know that using the indirect method we always start with net income when calculating cash flow from operating activities, and in our question it was given to us as $38,200. What we want to do is we want to find all of those items that are current assets or current liabilities, with the exception of dividends payable and cash, that either increased or decreased, because we know that every time our accounts receivable balance changes, if it goes up, we've incurred credit sales, which means sales revenues changed. We know that when we change our prepaid expenses, so say we decrease prepaid expenses like prepaid insurance or prepaid rent, we book an expense. And all those revenues and expenses will affect our net income. What we're trying to do here, and so therefore they'll be included in this figure. What we're trying to do here is we're trying to convert this net income to the cash basis. So we know that when we decrease accounts receivable, what happens? It means we must have collected more in cash than we ever booked as credit sales. When we book credit sales, we affected sales revenue. We want to reflect it on the cash basis. So when accounts receivable decrease, we want to reflect the net increase in cash. It won't be in the net income figure because the net income figure is only calculating sales revenue. So it's only including those increases in receivables that created sales revenue, right? We want to calculate we want to use the decrease in accounts receivable information to see how it affects our cash flow. Because our receivables decreased, it means we must have collected more on credit sales. That means we must have collected more cash than we booked as sales revenue. So to convert this net income figure to cash, we need to increase it by the amount of the decrease in receivables, which means we're going to add 2,000. We increased inventory. What does that mean? When you increase inventory, it means your cost of purchases was greater than what you reflected in cost of goods sold. Because every time you you decrease inventory, you will credit cost of goods sold. But our inventory increased at net, which means we bought more. Our cost of purchases was greater than was our cost of goods sold. So we want to reflect the higher amount as our expense, which was the cost of purchases. So we would decrease the 38.2 or minus 3,000 by the increase in inventory. You may remember some of our shortcut rules. We said that when we had changes in non-cash current assets like accounts receivable and inventory, when the account balance increased, we would decrease our net income to convert it to the cash basis. The opposite is true. When the change in our current non-cash current asset account decreases, then we're going to increase our net income to convert it to the cash basis. So you can see we're just doing the opposite here. So in our case, what we're going to do is when we see a decrease in a prepaid, we know that a prepaid is a current asset and it decreases. So again, we're going to increase our net income. And again, if we wanted to use the logic, we know that's because we would have expensed more during the period than we booked as prepaid. So if we would have expensed more, that means that expense would have been captured here, right? So every time you decrease a prepaid expense, the expense is captured in here, right? But we want to reflect anything that we bought in prepaids, and that would have been less, right? So we would have created fewer in prepaids or less prepaids than we actually expensed. We want to record, when we're converting the net income to the cash basis, what we created in prepaids, because that's the credit to cash. You remember when you create a prepaid, you would debit it, right? And then you would credit cash. That's when you create it. We want to reflect the cash impact here. So therefore, we know that we created or we used up less cash than we actually expensed. So if you had expensed, you would decrease your prepaid expense, right? So in other words, we did more of this than we did of this, but we want to reflect the decrease in cash, not the decrease in the prepaid. We want to reflect the cash decrease, right? So what we're going to have to do is, because the expense went up more than the cash decreased, we need to add back $2,000, okay? Because we want to reflect this, not this. This was bigger. We want to reflect the lesser impact, which was cash. So we're going to add back $2,000. All right. Now, we also notice that in the liability side, we've got an account payable which increased. And again, if you look at the shortcut rules, we notice that when we increase the current liability, we also increase, we need to increase our net income to restate it on the cash basis. So therefore, we're going to increase our accounts payable. We had accrued liabilities, same thing, they increased. And again, based on our shortcut rule, when we increase the balance in the liability account, we also have to increase our net income. Why is that? Again, because when we increase, say, an accrued liability, it could be salaries payable, it could be interest payable, whatever it is, right? Anytime we increase a liability, that means we book more expense than we pay down, right? So we want to only reflect what we pay down, right? Not what we expense. What we paid down was less. So we would want to increase our net income to reflect the lesser amount, which means we're going to increase it by $3,000. We've also got items like depreciation expense, and depreciation, as we know, does not impact cash flow, so we need to add it back. But the first thing we need to do is figure out how we got the $6,000. The other thing we notice, if we go through the data, I have listed here that we have a gain on the sale of an investment. Now we have that in our income statement in the question, and it says that's $8,000. Because the gain is non-cash, we're going to deduct it. But now let's have a look a little more closely and see how we got our depreciation. Well, if you look at the question, it's not in the statement, but it is actually in your question. It says the depreciation of $6,000 is included in operating expenses, so we can add it back. So if we add this column here, we see that we have a net cash flow from operating activities of $48,200. This concludes now our discussion on how you calculate cash flow from operating activities using the information we were given.